days, and then one attempt above 100K failed, and then we are back to 98 and 97 and 96, and our latest number, we actually broke below 96 as well. So the market is very weak, and the people are kind of sounding the bear market alarms. But this is where some of the models and some of the analysis that we have developed help to teach us or tell us where we are and whether we are actually in trouble or not. Let me take a quick look at a couple models that might help us understand where we are in the market. Is this a good time to buy? Is it a bad? Are we in a is the bull market trend broken, and so on? The first thing I want to discuss is a basic power law model that basically goes through the mean of the data or average of the data. And as you can see here, this line grows every day because this is kind of a proxy for adoption of Bitcoin. In bear markets, we go below the line. In bull markets, we go above the line. And we've been above it for quite some time, and but the line is actually at 88. So if you think of this as a nice, a fair value metric that comes from the adoption of Bitcoin, we are still above it. So even going back down to 88 wouldn't really surprise me. We visit this line a couple times, but the bull market will deviate significantly above this. So Bitcoin is essentially hovering around the fair value, more or less. And to make this easier to see, I've converted it into a an index, which I cannot show. I don't know what happened to my, yes. Okay. So if you look at this volatility adjusted power law index, this is a metric that converts those deviations from the power law into an easy to understand 0 to 100 metric. If it's at 50, we are exactly at the fair value level. But right now we are at 54. Essentially, we haven't even moved out of the neutral valuation zone for the last several months. And we haven't even entered the overvaluation and the bubble zone yet. And you can actually feel this in the market as well. Everything from the past experience that I have, it actually indicates that we haven't even started the bull market. It's kind of like the market is trying to still figure out what to do. After significant pump from the lows, we need to spend some time to build a strong foundation. And this all seems like a natural Bitcoin behavior. The last thing I will say before switching to Z's Crypto Wizards content is you might have heard me and Plan C talk about this quantile model a lot lately. That's something we are really investigating this month and publishing a ton of research on it. I pulled this chart from his analysis a couple days ago. That's why the price is a little bit outdated. Bitcoin moves fast, sadly. So, but this model basically puts the price action in perspective. So essentially, assuming that we have a distribution of prices for Bitcoin, the quantile model actually finds which quantile of this distribution are we at. And then if we are at higher quantiles, that indicates a higher risk or historically elevated valuation. And if it is at the lower quantiles, it indicates very low risk, or in other words, the likelihood of a pump goes up. Where we are is a couple days ago, we were at 67th quantile. Right now with the drop to 96, we are probably at 60th quantile. So yes, and this basically indicates that if you look at a distribution, we have covered, again, if you look at it, we have covered 60% of the distribution already, another 40% of it left. And I wouldn't even worry about, like, the way I would interpret these results is as Bitcoin kind of plays around these levels. If it goes higher and reaches a higher quantile, 80, 90, 95, those places are high risk places where there is a good chance for a crash. Conversely, if it goes down along the distribution that we have here, if it goes down, you know where exactly reversal probability increases. So this is kind of a valuation metric as well. Right now we are, with the change in price, we are at the 60th quantile, and quite a bit of room left in this cycle. Tune in. We're going to do a lot more work on this model. I think, in my opinion, this is one of the best trend-based models that we've had for valuation of Bitcoin. And one last thing I'll say here is, if you look at where we are kind of playing in this boundary region where we've tried to beat this level for quite some time in the past, and this seems to be a very important step in the market evolution. If we actually close above 100, 110, then to me it will confirm significant enough momentum to keep the price action going up. That would essentially kickstart a FOMO. In one of the prior analysis, what I did was I actually broke down the distribution of Bitcoin into several zones, and we are right now at the boundaries of the medium zone to the FOMO zone. As price goes up, and we are still in a mini crash, but if price keeps going up and stays above 100 in a reliable way, then little by little, FOMO energy will build up, and we will actually, try to go through a typical bull market path. So we are kind of in the middle. It's kind of we are at the neutral valuation zone. I wouldn't get scared at all. It's pretty expected numbers today. But let's see let's look at another aspect of the data from on-chain analytics that Z brings, and see what that tells us about the market.
Yep. How you doing, Sina?
Hey, how are you?
Not bad, not bad. Bloody days, hey.
Yes. The other day I was thinking, if I was talking to a client to help them analyze their portfolio and so on, and he was trying to over position himself, and something that came to my mind is a great test of whether you are acting based on greed or based on smart calculated analysis is if to assume that if Bitcoin price drops by 50%, would you get worried or would you love it? If you're at the place where you'd love that 50% crash, that's where you are well positioned. You are not over leveraged. You're not making a decision by emotions. And I thought that's a great test. You should always be ready for a 50% crash. So, but if that's something you won't really be able to tolerate, so that tells you you're ahead of yourself a little bit. So,
True.
Long story short, I love the crashes. They're good.
Nice one. So yeah, let's just look at. I want to start to just look at. I know it's not a good time for our shitcoiner friends to look at this chart, but that's the reality. I'm showing here the BTC pair of the endless list of shitcoins, and this is just the last 30 days. And I excluded the Ethereum and Ripple. Just looked at the whatever was by market cap listed after Solana, and that's the reality of the market. That's why you see Bitcoin is above 95. I think is it 95? What is the price of Bitcoin now? but people are panicking, and the level of panic and the level of pain is literally because Bitcoin went the other way, and the 14 13,000 list of shitcoins, or if you want to count the meme coins and Solana in the list, it's going to be in order of millions of assets that you could trade literally now. They're not doing great. That's why you see I mean, Twitter. If you go look at the social medias and family groups, they're all just screaming pain. That's because they chose the wrong casino to play. Instead of just betting on the right horse, their horse is dying, and that's why 90,000. Like imagine, like you're 10%, 15% below the all-time high, and that the pain is equal to what? I mean, that's just qualitatively. I'm judging that. It's the same pain that I saw after Luna going down, because a lot of people are losing money, unfortunately, on all these assets, and this is just monthly.
And let me tell you, the problem they have is like previously there was a lot of coins, but some of them actually had attraction, like real developer base, actual communities, actual papers, studies, science. Like Ethereum right now, people there are actually developing new tools, interesting ideas, but ironically, that's the worst performing of the big guys, and it's increasingly becoming clear that it's not about the tech. Nobody cares about technology of these altcoins. Nobody cares about the particular utility. They all essentially go up and down by emotions, and essentially all their valuation is meme valuation. And we are seeing that right now. It's the era of memes. Memes are essentially killing the altcoins, and they're going to replace. I mean, take all the liquidity out of alts, move it to memes, and then you will see coins just go up and down for zero logical reason. And this process will continue to kill altcoins, but it will also kill itself. Like the meme coin complex will expand so easily because it's so easy to create a new meme coin. Once too many people do it, market will be exhausted and all memes crash, and there would be no money in alts as well. There is only one real asset that people agree it's a good store of value, and then there is all this casino with altcoins and meme coins and so on, which once it implodes, all that money will flow back into Bitcoin. So essentially, over the long run, you shouldn't feel FOMO that XYZ coin is going up or down. All that money is getting recycled back into Bitcoin, more or less, sooner or later.
Yeah, I agree. Like I heard two words that describe this situation very well. Like I think I don't know who's mentioned it, and it was the nihilism. That's what they're saying. Like people see there's no chance to just fight with inflation. They see their wealth is literally they are sitting on a lot of debt. They want to attend some sort of lottery, and it was much easier to have that behavior in this cycle with the Solana, because it was much cheaper.
Let me tell you one thing. This is a
Yeah.
huge mental error, cognitive error. When you tell people buy Bitcoin, they're like, okay, I only have like $10,000. I'm not going to get rich if Bitcoin only doubles by a couple years later. Well, yes. The only reason the guy says I can get rich is if I go play into the meme coin casino. But the thing is, if Bitcoin grows your wealth more than all the other assets, all the other major assets like stocks and real estate and so on, that's good enough. When you try to get rich in the casino, more than likely you will lose what you have already. So essentially, your choices mostly are either accept one of the best performing assets on earth, which grows much faster than many of the traditional investment choices, or try to play the get rich quick game and lose what you have. The probability of losing your money is more than earning money when you play in this casino. So if you really want to get rich quick, better figure out a way to buy a lot more Bitcoin instead of wasting your time with other coins.
Yeah. And the other word I heard, it really described what happened this cycle, is fragmentation. So last cycle, like you said, you should have be like a team of developers, come up with some sort of idea. You had to spend some time on having a white paper. I mean, it would take some time to do all this, do like marketing. But right now, you just go on pump the fund, just create your coin, and just jump it. So that fragmentation, you saw coins market cap going by 10 times per day. Actually, one of them like Trump coin and I don't know, Fart coin. If you look at them, they're just ballistic. It was like a ballistically going up exponentially. The market was going up. That was actually draining the market. It was
Trump
just
coin is
sucking the.
down like 70%. Melania is down 90%.
Yep.
And
So when you look at all these tiny projects, they were just taking money off the table. The rock pools was happening. They were literally claiming we have no intention to deliver any utility. We are just here to do the rock pool, and people were just pouring money there. So that's where the money went. That's where the money that you were expecting to pump your bag from last cycle to pump your bag, it just went away. That because people are still saying alt season. That was alt season. That was alt season, but it was not your alt season. That is the reality, and that's the pain. And I'll just list a couple of, I mean, shitcoins that I remember from last cycle. Look at BNB, and it's compared to the BTC pair of coins. I think the reference date is January 2022, so it's like almost 3 years. If you look at them, it is. I think you can. I should zoom in, but I'll read for the audiences. Like SPY, 40%. BNB is 46%, Link is 63%, DOT is 92% down. I mean, against Bitcoin. Arbitrum is 90%, Matic is 94, Phantom is 93. So it is crazy. Like they're plus 70% down after waiting 3 years. And these investors were waiting for their back to pump back. Even in dollar value, some of them are lower. I'm not talking all about.
essentially, a lot of these people that said, okay, let's diversify into altcoins to just get more Bitcoin, they actually ended up with less Bitcoin, significantly less Bitcoin.
Yeah, it's sad. I'm talking about SPY, like that's the stock market. Even that is 40% down after 3 years of waiting and waiting. That's why you see a lot of investors just came into game and start to buy. I mean, to control the risk, I would say, to integrate ETF stocks, ETF tickers in their portfolio. But what I want to describe now, just talk about the market. You could see the pain is mostly because the shitcoins are down, and the best indicator that I usually use to show what is the pain or how demand is dying or diminishing is using this beautiful funding rate heat map by the CoinGlass. Basically, what they're doing here, they list, I think, top 30 assets by open interest. They show the annualized funding rate. And obviously, the red color, the warmer the color is, that means the funding rate in that asset is more than, I mean, higher and higher. That shows the appetite by investors' appetite to go pay the premium funding rate to be long in the market. So somehow it showed the demand. The colder the color is, that means the funding rate is less and less, and sometimes it's negative. So what I do here, I'm filtering the times and intervals that the funding rate is less than 4% to negative territory. Why 4%? Because 4% is almost the base interest rate you can get by having bonds. So if you're making less than 4% per year, you're not going to go and um, um, collect the funding rate. That's when the demand is dying and people go to somewhere like the bonds to collect the 4%. So using 4% and below as a threshold value, you could see when the market is in pain, like what happened in August 2024 when market was dropping, the number of assets from top 30 that have a negative funding rate or low funding rate is just growing and growing. And as you can see, from November to early December or mid-December, market was rallying. They were having some sort of rally in dollar value, not much in BTC value, unfortunately. But you could see that interval was not having too many assets with negative funding rate. Right now,
Black is positive?
Yeah, if black is positive,
Okay.
literally this. See, this is black. Actually, this is better if I show the positive. You can see the positive is just gone after late December. That means market was showing some sort of lack of appetite in the perpetual side. That was an early sign. Okay, market is just not have that much drive or momentum in the perpetual, but that doesn't mean always, because you could see sometimes they just die for a bit and then come back. But since late December, you could see even in Bitcoin we didn't have much overheated perpetual. Anyway, so this is showing perpetual is one of the earliest market that show the weakness because it's high, a lot of liquidity there, and that's the first market you could see is reacting to the reality. And right now you could see the funding rate dropping and dropping. If I want to focus on Bitcoin and only show top three, I'm saying top three by open interest: Binance, Bybit, and OKX. And I think we reviewed this concept a lot. The 0.1% is the neutral value in funding rate. What does that mean? If the funding rate on top three exchanges and the mean value of all funding rates is above 0.1%, that means, okay, compared to the neutral value, there is some sort of like pressure, buy pressure in the perpetual market that is willing to pay the premium, which is the funding rate, to be long in the market. When it's dropping below 0.1%, then it shows those people who were willing to pay that funding rate are gone. And as you can see, after we hit 108, 100,000 and $108,000 in 17 or 18 of December. Since then, you could see even though market was going sideways and it came back to 105, 107 again, but the reality was the demand in the perpetual market was dying since mid or late December. And right now, it is sitting at 0.05, which is 50% below the neutral value. And if you,
So that
yeah,
means that means right now the balance of the market is switching to bearish positioning in the perpetuals.
yeah, or
And if
better to say lack of bullishness. We don't have aggressive bulls in the market. Yeah, but if we get closer and closer to zero, yes, that means not only we don't have no demand for being long in the market, we are actually having some investors that are pushing the price down by shorting the market aggressively.
but if there is equal bullish and bearish positions, wouldn't we go to 0.01, or would be at zero?
No, it would put 0.01 because Binance, which is the largest OI, caps the, like, if the, let's say the pressure in the market is pushing the funding rate between 0 and 1, okay, 0 and 0.1, Binance is capping the funding rate in a neutral value. It incentivizes you to be long and provide liquidity actually for the people who are long. Because if you go get short, let's say market is in neutral value, zero funding rate, it incentivizes you by 0.1% funding rate. Is incentivizing people who provide liquidity by shorting and providing liquidity for people who want to be long. So if at neutral value market, imagine we have an equal force in the market, Binance give you some incentive to go provide short side liquidity by just and get 0.1% per 8 hours, and that would push bring liquidity to Binance for people who want to be the other side, which are the long side. You know what I'm saying?
And
so when you look at
more bearishness, we would jump from 0.01 to 0 and negative at
yes.
Okay, that's a form. Okay.
Yeah, but why we are having values between 0 and 1? Because Binance is 0 and 0.1. Because the other exchanges, there are big exchanges that are not following that capping. They're either positive or negative. Arbitrage happening between these order books, and that causes you see the mean value is not 0.1 all the time, 0 or 0.1, because the other exchanges have different values, and that's the arbitrage that's happening between all these exchanges. But the reality is Binance is so big that is affecting all other exchanges. That's why 0.1% is the neutral value, and we are below neutral value. When we get to negative territory, that means the sell side is so strong on all major perpetuals that even the capping function in the Binance cannot hold the funding rate above 0.1. They are selling so strong, and people go strongly, actually aggressively short the market. So if we want to expect a long, I mean, I I believe if we want to see another rally, first we have to see what we saw in November, or what we saw in past November 2023. The funding rate moving average, the weekly moving average, to just be a little bit short, not just the hourly, breaks above 0.1% at major perpetuals, and the mean value as well. That will be the early sign. Okay, the aggressive long investor are back, which
Yeah,
we
I mean,
don't see
there are two
unfortunately.
signals here. One signal is if the aggregate funding rate is going down, that means the futures market is getting less and less bullish.
Mhm.
That's not great because they're pulling capital out, but that capital is just sitting somewhere else in cash or stablecoin.
Exactly.
But when this perpetual funding rate goes down enough, that actually ends up being a really good positive and bull sign. So when we go to negative, if you look at historical numbers, typically when the funding rate is very low, that's a fantastic risk reward place to go long.
Yep. Like look at the OKX. OKX is the most volatile funding rate. That's the first one that usually go to negative because it probably has less liquidity compared to Binance and Bybit. That's why you see they go to negative first. But you're right. When we see this is the 24-hour moving average, February 3rd, OKX became negative, and Binance and Bybit got really close to zero. But when we go back to bottom of the barrel, like look what happened in the May or July, all of them became negative. May 2024. See, all of them went almost close to the negative territory. That is when you say you can tell the aggressive bears are in the market, and most likely they are leveraging to add to the sell side. They are really easy to be liquidated, and the sell pressure is really close to be, I mean, at least um, cool down for immediate term. That's why it's bullish, because we are going way away from the mean value in the funding rates, and it's low risk when you're getting lower than your mean value. Yeah, and let's hope we get some negative, because that means the price is somewhere that is fair from perpetual perspective. And I wanted to get to something else, because a lot of people might, because we are trying to paint the picture for people why this happened. Like I said, the fragmentation happened, the liquidity, instead of being focused on top 10 asset, it was on millions of tokens being launched on the last 3 months on Solana Pump One. Some of them got enough liquidity to be listed and be traded, and those tiny projects just ate the liquidity that was introduced to the market by the retailers. And now you see tiny, bit by bit, tiny bits of the money went out of the market, instead of seeing them coming to, for example, I don't know, your Link or Uniswap or whatever. Those projects are still big, and pumping them by 3 or 4 times is so much harder than pumping Melania coins. See, so that's where the money went. The other thing I wanted to tell people, including December 2023 all the way to April 2024, where that was the first rally we had. Let me just zoom in a little bit. And then we had a rally starting almost August 2024 all the way to December. During that two bull or rallies, the long-term holder, the long-term investors, the investors who wait for the price to get to the price that is a fair price to them, they spend in two big waves, and they start to sell the coins to new buyers. And I think in the first wave they sold around look I think yeah, I think around 1 million and 1 million. So they sold 2 million coins, I mean the long-term holder, to the new investors. That's actually two wave of sell-off in the market. And when you look at the percentage, At the first wave, they sold up to 25%, and I think in the second wave, you could see 35% drop in their holding, the long-term holder. And if you compare to the previous bull market, it's pretty impressive. You have two sell-off in this cycle, and market was still, I mean, up to yesterday or this morning, it went above $100,000. Like, we had a lot of coin change hand in this cycle. Usually, after seeing these wave of sell-off, market enters the 50 to 60% drop. But this cycle have been pretty resilient. What do you think, Sina? Like, we had a lot of sell-off. People are saying, okay, from 108 we dropped to 95. They don't see the same pressure on the market push the price from 69 to 30, 28,000 back in 2021. But right now we have a patient, at least so far, we had a patient buyer in the market who was not willing to buy at, I mean, when others are FOMO, but when everyone are very scared, or whenever like the price went below or close to the cost basis of the recent buyers, they start to jump in and buy, and that's why the price didn't drop from 108 to 50 or 60,000 so far. And I don't know if it's going to be the case from now on, but so far we had a really quiet, patient buyers with a lot of liquidity. I think you're mute.
Yeah, a couple things are happening. I think one of them is that just naturally, when the market gets bigger, it's harder to move the price around, and that has definitely happened in this cycle. From last cycle, we've had much bigger. We've 10x'd in terms of this price, and that just makes it much harder, reduces volatility. And this is something we can verify empirically. When you look at the day-to-day percent change in price, it's a clear downtrend over the years, like year after year, cycle after cycle, volatility is going down. The other thing is, after ETFs appeared, we now also have this passive buyer flow, which brings in the same amount of dollars regardless of Bitcoin price. So when Bitcoin's price goes lower, they actually end up buying more Bitcoin with the same amount of fiat. These people are very disciplined. They know that they are from, compared to the average crypto bro, they are more disciplined. They better understand the idea that if you are in something for the long run, the price going down is actually a sign to buy more, not to sell. So we have a lot more mature, we have a lot more, more traditional, more disciplined investors in. The third factor is we actually have a lot of people staying on the sidelines. Like, when Trump came to the office, Bitcoin went up so much and crushed the 100K, and a lot of this woke up a lot of the traditional big pocket investors. But they, being smart, they were not FOMOing in. They were looking for entry points, and we see them daily. We've, like, even at 21st Capital, we've had a couple talks with people with insane amounts of money trying to establish Bitcoin reserves, Bitcoin treasuries, and they are sitting on big pockets of big piles of dollars or euros and such, and they're waiting for entry points. So if the price goes down, a lot of these people, like TradFi, Bitcoin enthusiasts that are just learning about Bitcoin and they're sold on it because now the US is fully on board, SEC is on board, the president is on board, all the parts of the US government are on board. Now they feel ready to jump in. They're just waiting for entry points. And this is actually a really good, positive sign that the lower the price goes, the more likely that these buyers will jump in, and we will not see those significant crashes that we've seen in prior cycles.
Yeah, interesting. And speaking of like ETFs, I just thought maybe we should show this because I saw a big, I mean, not really big, but a misleading conversation about the ETFs. This is showing the 7-day moving average of the net flow to ETFs. I mean, all ETFs, the aggregate. And I think in dollar value, Bitcoin was it's for yesterday, I think. The 7-day moving average was between like 40 last week from February 3rd to February 6th. It was between 50 million to 220 million. This is the net. And for Ethereum, it was actually went up all the way to 69 million. And people were if you go look at my Twitter, I just talked about it. You could see a lot of titles like this one today. BlackRock bought that much Ethereum, or Ethereum on the in total inflow for a specific day is that much by like a wallets that they've been attributed to BlackRock, and people are wondering all that buy pressure on Ethereum, why the price is not moving. So I thought maybe I put like a little thread together and I explain, first of all, if you want to talk about the buy or sell, that is not informative enough. You have to look at the net flow to the ETFs, because some titles are just talking about the buy side and the inflow. They're not talking about how much sell was actually reported. So you have to talk about the net flow.
Mhm.
And even if after looking at the net flow, you have to compare that net flow to each asset through the ETFs. For now, it's just Ethereum and Bitcoin with the size of the market, and see if that much money into Ethereum or Bitcoin is big enough to move the needle. That's where people are making a mistake. This is showing the normalized size of the net flow to Ethereum by the blue and orange for Bitcoin, normalized by a spot volume. We're using a spot volume as a measure to show how big that market is. And when you normalize the net flow to Bitcoin and Ethereum by the spot volume of each asset, you would see that's why Bitcoin ETF inflows were much, much more significant and impactful compared to the Ethereum. Like for Bitcoin, it went to up to 10% in November. It went to almost 9% in late December 2024. And even a couple of weeks ago, like late January, it was above 7%. But for Ethereum, barely came above 3%. That means all those numbers you see, and they're not wrong. They're talking about they're technically correct. That much inflow was recorded. I don't know when they're reporting it, probably yesterday or today. That much net flow was actually recorded to the ETFs, but that net flow is not big enough to move the needle. You have to look at these numbers in a uh, correct perspective, not focusing on just the absolute value. 200 million Bitcoin came on Ethereum came to, I don't know, bought by Trump Jr. or it was bought by that company. You have to divide it by the size of the market and see if it's impactful enough.
So basically, if you're in Ethereum, condolences. They said the upgrade to proof of stake will make it fly. It didn't. They said the deflationary upgrade would make it ultrasound money. It didn't. Actually, yesterday, Ethereum recovered all the reduced supply, and now it became inflationary again. So that didn't work. It was supposed to actually make it go faster than Bitcoin. Sadly, it didn't. It was supposed to flip in Bitcoin. It didn't. Then after Bitcoin moved up, they said alt season is coming and Ethereum is supposed to fly. It didn't. After Ethereum ETFs were approved, they said this is the time where Ethereum will fly. It didn't. It actually sold off more. And then they said, okay, as Bitcoin breaks 100K, alt season will begin and Ethereum will fly. It didn't, and it's actually doing worse and worse and worse. Bitcoin goes up to 100K, Ethereum just catches up a little bit. Then, as Bitcoin does a sideways price action, Ethereum loses more. Then Bitcoin loses a little bit, Ethereum loses more. Then Bitcoin gains a little bit, Ethereum loses more again. It's kind of like because, as like I said, most of valuation is meme valuation. It's has lost that sexiness just because there are so many more memes that go up and down faster, and there's much more exciting pump and dump going on in there. What else is left for the poor Ethereum? And actually, among all the other altcoins, I would respect Ethereum the most because there is actually an active, a smart developer base here. The other ones are just saying We are a name on a chart with nothing else. But these guys are actually developing some things, developing technology and so on. So if anyone actually wanted to win based on utility, it would have been Ethereum, which that theory has clearly failed at this point. So
Yeah,
condolences, and I have to sadly say, I told you so.
yeah. And I have to add to you what you says. When Ethereum was still proof of work, because I see myself more proof of work maximalist compared to Bitcoin maximalist. It was a sad day for me when they started to merge, because I'm not saying I knew 100% what happens, but I knew as soon as you enter to that territory, try to be more on a pumpermentalist and care about how you can just absorb more liquidity. They're going to be a better horse to bet on, which turned out to be Solana. It was cheaper, low fee, and matter of fact, we put a report recently with Gemini that I thought that it's relevant, and people can go and find it on Gemini. And in that report, we talked about how different Ethereum was this cycle when it was compared to Solana, because that was the closest rival, and Bitcoin actually. This chart is showing the realized cap for the we call them hot supply, or that's the term we use, but literally is measuring the amount of dollar value changed hand by the new investors. So literally it's showing the most volatile segment of the supply. And when it is rising, that means the new investor, the people who FOMO, the probably high frequency traders are in the market. As you can see, in Bitcoin case, we went up to 90 billion per day. I mean, when Bitcoin was 108, that's $90 billion in less than a week
So
changing
clarify
hands.
which color is what?
The orange is 1 day to 1 week, and red is less than 24 hours.
So
And
both are pretty hot money.
yes, and just bear with me. These dollar value is not like if I send the Bitcoin to you, and today Bitcoin is $100,000. This is not measuring that. It is measuring this concept that I'm going to explain. Is measuring the profit that been realized by that transaction, which means what? I had a coin, bought it like 2 or 3 months ago at 60,000, and today I send it to you. I spend it at 100,000. There's a 40,000 profit been realized here. That's wealth. That is the profit. That is the premium, or that is the I don't profit that I'm actually taking off the chip, and you are the one that are injecting that extra 40,000 by buying that coin at 100,000 from me. This metric is measuring that 40,000 aggregated value of the wealth being injected to the market, and it was almost $90 billion from the I don't know, the bear. I think in the bear market it was around 15 or probably 8. I don't know what was the lowest, but it was, you could see clearly the retail or new investors. It's wrong to say retail. It could be a big investor who entered and paid that premium and bought that coin at 100,000 and paid that 40,000. You could see the demand was just ramping up when the market was going up. But when you go to Ethereum and compare, look at Solana. What happened to Solana? For Solana was 15 billion, and it was barely 1 billion in the bear market. You could see Solana had a behavior similar to Bitcoin. You could see the investor chose Solana. But when you look at Ethereum, the baseline was around, I don't know, like 3 or 2 billion. Just went up to, I think it was around almost like 10 or 12. I have to have the live. Unfortunately, I don't have. I think 11.6 is the peak. You could see in Ethereum they didn't experience that demand entering the market. Demand did not choose Ethereum. Obviously, it chose Solana. And when you go a little bit deeper and look at the, this is comparing those two. Look, Ethereum was almost close to the baseline in the bear market, but in the baseline for the Solana in the bear market compared to the peak, you could see why Solana ecosystem was the winner in this cycle. Retail new investor chose Solana, and when this is crazy. Look at the number of active addresses. For Bitcoin, is a pretty constant number. It's not really significant from change from the bear market because it's a huge ecosystem, and we're not. It's becoming some sort of like store of value. So activity not necessarily means like the valuation going up and down. Yes, sometimes activity going up in Bitcoin, that means retail entering the market, and it's going to add to the valuation. A little bit premium is going to come because of the speculation. But Ethereum and Solana are thirsty for activity. Their definition, like Ethereum, literally after merge bet on the more activity in bearing the supply. But look what happened. Ethereum is just plateau. But look at what happened to Solana. Solana active addresses went all the way. I think it went to 14 something million per day, and that's the moving average. By the way, that's a 7-day moving average. So all in all, you could see
Exact theory. This is the exact theory that people had. It was like, once you get into this utility game, you would lose your. You would say, okay, let me compromise a little bit of my decentralization to make things faster, better, make this development faster, right? If you're more centralized, you can quickly make decisions. Okay, but that's good. But then somebody else will appear, and then they will have more centralized systems and faster development and more user friendly ecosystem, which will then kill you. So you've essentially lost your main advantage, and now you're going for to make yourself more and more look like a company. And then guess what? Like, another company will show up and make it even more centralized, and everything will be faster. So you've lost your permanent advantage.
yeah, that's unfortunate. And given that we are entering, it looks like we're entering to a bear. I'm not talking about how long it's gonna take. I'm not gonna speculate exactly where is the bottom formation, but I think people might be interested to see what are the tools that we can use, and start to just weight the bears and see where this bottom formation. Let's say we are entering a bear market and we are speculating what could be the range, not the exact price. We cannot predict. No one can. Maybe tomorrow a macro event happens and market just sink to whatever, or you could jump to 150,000. But we're trying to use the historical value and the investors' behavior and try to just see what would be the most possible or probable range of bottom formation in a bear case. Do you have anything to just get there? I think you talked about the quantile. Do you have anything else to just use that to be used to do that? Like, I mean, do some sort of bottom formation sizing?
Well, a couple of things is initially that I said, like our fair value metric is at 88,000, right?
Uh-huh.
So if we get there, we basically go back to the pure neutral valuation, and
Nice.
it's a pretty, like, from a trend perspective, we essentially go back to our trend.
Okay.
So yeah.
So I have a couple of models. Let's just look at them. I'm gonna just review them. The most interesting, and I think is the oldest one, Mayer multiple, which is not an on-chain metric, is it more a technical metric, which uses the 200-day moving average as a fair value, and that number is around 78,000. I'm just reading this chart from Check on Chain, and Check has a list of beautiful charts. This one is, and he beautifully tried to color coded each range, but the fair value in this model is around 78. So as you can see, the majority of the Bitcoin history was, I think, around 50% or more than 50% of the Bitcoin historical price were above this fair value, and the other half, which is the bear market or deep bear market, was below that 200-day moving average. So 78 all the way to 117. That is the range that market is usually go sideways and try to find its leg. I mean, try to find some sort of mid bull market base. But if we break below 78, based on this model, we are entering to a deep bear market. We're not saying we're gonna break below 78, but that is a model that it can actually measure the risk in the market. If we break below 78, that is somewhere based on Mayer multiple, we have entered at a very low risk territory. But
let me mention one quick thing.
sure.
Very interesting. That 78 that you mentioned exactly is the median value that we have in the quantile model. So if you look at like if you look at a part of this data of where the points are above the model, half of the points are below it, that would be. So it actually makes a lot of sense that if we are still in a bull market, not going below 78 is a really positive sign.
Agreed. So it is better to say what you said, if we stay above 78, that means, okay, we had some weakness, or the way that Czech put it, chop solidation, like we are trying to consolidate while we see a little bit of weakness, maybe a little bit long-term moving average is negative, but it's not like a dropping 30% in 2 days, that kind of thing. But if we go below 78, we are repeating the same part of history that we had probably in May 21, or it's going to be the same structure that we have in January 2022 if we break below 78. And that's one model. But it is a really good model because a lot of people, refer to it, and it's pretty nice model because you use the 200-day moving average, and that quantile, or the probability of not probability, the portion of history being below that moving average is around 50% of the time, and it's really interesting. The other model that I'm really interested in is the cost basis of the recent buyers, new buyers, short-term holder. We use all these terms, but they are implying the same concept. And why we are separating the new buyers and new investors? Because not the majority, the the new buyers that came to the market in last 155 days, statistically, it's been proven that these investors are more price sensitive. They are the one that can react to volatility, or would react to volatility, compared to the longer term holders, which is plus 6 months. Those investors mostly wait for the price that is right for them and start to spend. But the new investors are the one that are prone to react to sell side, for example. Let's say sell side in the market go up, they panic and they start to sell. And their cost basis is a very nice model that actually is very useful when we want to define or confirm entering the bear market, or a midterm. I'm not going to say like a couple of years, but it's confirming the market have enough experience and have enough sell side that you should expect a midterm to long-term bear market. And when look and why? Because when the price breaks below the cost basis, that means the majority of the recent buyers have been in loss for enough amount of time to kill the demand, at least for a medium to long term. And when you look at the cost basis, is around 91.9, 92,000. So what does that mean? That yeah.
Just wow.
Yeah. Yeah, and you saw last week we had a little bit bounce back by 92. I'm not saying it's because this model is so predictive, but it explains that when the price crashed, or people maybe use the correction, it's a really subjective term. I don't know if there's a mathematical definition of crash versus correction, but let's say it corrected to 92. That was most likely because the price got close to the cost basis of the recent buyers. So that means the profit almost just got close to zero on average, and they lost the incentive to spend in profit because they have nothing. But if the price keep breaking below their cost basis, some of them might get, oh my God, we're gonna be in a bear market for a couple of years. Let me sell at small loss. Then it's gonna be the next person that, oh my God, it's 20%. I'm gonna jump out. So that's 92. If we just break below and stay there a couple of days, I expect that's gonna cause some swing to the downside. The same thing that happened back in June 2024. We broke below the cost basis. By then it was 64,000. The market just went sideways all the way, and it broke below the cost basis of the new investors by one standard deviation. So if you look at the yellow line here, is one standard deviation below the cost basis of the new investors. And usually that yellow model, which is like I said, is a variable that is depending on the cost basis itself, is a very good bottom indicator. So what I'm saying here,
but do you know how that standard deviation is calculated? Is it using all of the data, or is
all
it
of it? It's all of.
Okay, so it's kind of
using
cumulative from the beginning all the way to the latest date.
Exactly. It's cumulative, the ratio of the price. Is cumulatively using the ratio between the current price and cost basis of the new investors, and is measuring what percentage deviation we had from the cost basis. And in the bear market, one standard deviation is the yellow line, and interestingly, it's showing around 71, 72,000. What is this telling us? It's telling us in a case that we break below 92, most likely in midterm, by midterm I'm talking about 6 to 1 year, if we want to continue going down, the bottom formation most likely will happen between 70,000 to 92,000. And that 78,000 in Mayer multiple, it's just closer to higher band, or yeah, actually it's in the middle almost. And it's really interesting. That range is becoming a range that, in case of a bottom formation, people can expect meeting or hitting the band of this range. But if this chop consolidation or going sideways continue and price go down, the moving average or the cost basis of the new investors goes down as well. So we have to revisit this model every couple of weeks and see what is the number. I'm not saying 92 forever.
This is how I would understand the numbers here. If it's a garden variety correction, only the recent buyers, which supposedly have weaker hands, they'll sell. So if it dropped to 91, all these recent buyers are exhausted. There is no profit in their hands, so it stops there. But if it's a bigger correction, right, and the price, like if the correction has a lot of momentum and the price drops below that level, then you're entering a place where people may panic sell and so on. So it's kind of it's a place where you might get a bounce if your correction is not supposed to be a strong correction.
Exactly. It's a really interesting concept, the new investors. But yeah, I use it more often recently because not only gives us a really nice support in the bull market and resistance in the bear market, because the same concept happens in the bear market, what's the other way. When price get close to cost basis of recent buyers in a bear or prolonged bear, as soon as they get a little bit profit, they start to spend because they say, okay, oh my God, we're gonna be bear market. I got my money back. Just let's get out at break even point. So that's why this model is really dynamic in concept. So you have to look at it and see what is the phase. Are we below the cost basis of new investor for a long time? That means okay, we have been in a bear market, and use this model based on what is the sentiment. At current sentiment, like you said, if we stay above 92, or if we just break below temporarily and come back, that means okay, we had enough demand, we just had some pause. But if the price breaks below 92, a cost basis of new buyers, and keep trending there and keep trading below 92, you could see, oh my God, the new investor realize, okay, it's a bear market. You could see they're realizing more loss than loss. And between 71, 70 something and 92, I think I would be happy with a midterm bear market now to just release some. And people already sold 2 million. Like I said, the long-term investor almost spent 2 or 2.1 billion in 2 different waves, and that's a lot of wealth being changing hand in this cycle. So I actually were really surprised the price was above 100,000 in over the last couple of weeks. And let's see what happens. But 71 to 92, I would call it in a short bear market. And let's see what happens. The other model I wanted to add, because right now we looked at the Mayer multiple, we looked at the cost basis of the short-term holder. There is other model that I really like to talk about, and that is the MVRV. But MVRV, which is the ratio of the price to the cost basis of all investors. MVRV, if you look at the historical value and just compare what was the maximum MVRV, what was the amount of profit we saw each cycle, you could see every cycle there was a decay. Like in 2011, we went up to 8 times higher than the cost basis of all investors. This number started to decay. In 2021, we went to almost 4 times. And in March 2024, April 2024, we went 2.7. You could see there is a decay. That means the market is
that a model? Or
it's MVRV. It's just MVRV.
No, but the line is that
it's just I did it by eyes. But the blue lines is the actual maximum value. This is I just wanted to show there's been a decay in MVRV, which is, like you said at the beginning of the call, it is most likely because the market is so big, it is hard to move the price. It's so hard to have 19 million coins at 800% by average profit. It is becoming really huge. So that decay is expected. If we want to do a statistical analysis, we cannot compare 2.7 by 3.9. That's when your method, like the same method you used to, I think what was the model using, and you fixed the decay? What do you call that model?
The one I did?
Yeah.
Yeah, I had a volatility adjusted model. So essentially, I measured volatility in each of the cycles, and turns out that one of the good ways to measure the depth of the market is to see how much volatility exists in every cycle. Once you correct it based on that, then the decay goes away.
Yeah. So what I did here, I said, okay, MVRV is a decaying indicator, so we have to use a method to normalize it. And Z-score is very popular. And here in this example, we use the cumulative Z-score. As you can see, even the cumulative have some sort of decay after 2018. And then we thought, okay, let's just do a rolling window for Z-score. Last 2 years of data, last 1 year of data. After doing all the studies, I just don't want to take so much time. If you look at the 1 year moving average or 1 year rolling window to calculate the Z-score, you could see it gives you a pretty stationary indicator. So this one is the 1 year rolling window standard deviation. We use the standard deviation 1 year rolling window and 1 year moving average, and looked at this, normalize the deviation from 1 year moving average by the 1 year standard deviation. So that's MVRV 1 year. That's what I'm going to call. As you can see, this indicator became a really nice stationary indicator that you can compare the current value with historical values much better than the cumulative Z-score. Using that, we develop a price model. How? The MVRV in the bear market shows when is 1.5 standard deviation below the mean value, it is absolute pain in the market. And when we are above 2 standard deviation from 1 year moving average, that is a sign of extreme temperature in the market. It's so overheated. And we saw that structure 1, 2, 3, 4, 5 times in this cycle, and every time we had a correction after. So using that, we can actually have a model similar to the short-term cost basis like this one, but here we're using what? We're using the 1 year moving average of the price and a standard deviation above and below. If you look at this, let me just zoom in at the cycle. It is actually cycle. The mean value is 96,000. That is the 1 year moving average of the price. One standard deviation above is 106. 1.5 standard deviation, which is literally where the bear market or the extreme pain for the investors is actually being experienced in the market, is around 79,000. That is really interesting. It is close to that 78,000 that we saw in Mayer multiple. So when you put all these models together, it looks like below 92, we are actually entering at least a midterm bear market. Between 70 to 78 is where we saw in bear markets the bottom was in, but we had cases that an external factor like Luna and FTX pushed that bottom formation even lower. So that's the scenario that we're going to lay out. 92 is the threshold between still in bull or no, we are in the bear. And between 92 all the way to 70 to 78 is where the bottom was in, unless a macro negative event happened, like a war or Corona or Luna or FTX. Any of them could actually add to that pressure. But my sense says probably, I'm not sure, we have enough buyers with enough liquidity that will jump in, and probably the bottom formation, in case we went lower, is going to happen between 70 to 78, unless like a war happens. I don't know, trap wars. There are tons of crazy shit can happen. What do you think, Sina, of these price models?
No, I think it makes sense. Yeah. 92 is the first place that if we actually keep going down, 92 is the first place we might see a bounce back. And but if something more major happens and we enter a mini bear market, the range between 70 to 78 also makes a lot of sense. Exactly. I mean, different analysis are kind of showing us a similar number. The quantile model's median is at 78 too. So Bitcoin's price history, if you normalize today's price by all the historical price action, if you go below 8, that's where Bitcoin is expected to only spend half of its time there. So it's a pretty low number at 78. So it should be a significant issue. It should be a major problem. Like, let's say the US completely changes the plan and says, okay, hey guys, we hate Bitcoin from now on, and everything we said was a lie. And no strategic reserve, no reserve at all, and we're actually going to sell some of our Bitcoin. That's when that kind of thing is where I would expect to push the price that low. But it would be very interesting. I actually don't feel a crash. Don't feel like a crash up down to 92 is like anything even important or anything critical. That's going to just kill a few more of those meme coins, and then we will grow back up from it. And even if it goes lower, people have to treat it as a fantastic buying opportunity, which actually we might begin discussing that, right? If we have a significant crash, which at some point we will, maybe not too likely this year, but we will have a bear market. There are well-tested, smart ways to begin investing and begin building a Bitcoin positioning yourself for the next cycles. A DCA and a few other variations of it would also be interesting. So if we do have a significant crash and you have money on the sideline, try not to buy all at once. It's much better to use strategies like dollar cost averaging and different variations of it. And you can make DCAs smarter by looking at some of these risk metrics that we have shown you. The lower it goes, you try to buy more, and that's kind of a smarter way to invest in a down trending market. Nevertheless, again, I don't feel much. If it goes up, it feels good. But then it also feels like the opportunity has passed, and if the Bitcoin goes down, it's more. I think of it as a temporary pause and some more time to accumulate more. In fact, I would love that. Like if you go back to 75 or something, I have some extra money that's left over, and that's where I will bring that in.
Yeah, like my DC, I don't recommend this model to anybody, but to just give you some sense how I'm using this model is I have a DCA no matter what, like let's say $2 per week. That's my base DCA. But when I have a lump sum and I'm just putting on the side and I wanted to buy Bitcoin, but market was ripping up and I wasn't like really feeling good to pay that much money for Bitcoin, I put that aside and it start to trigger my heavy DCA when we break below the short-term cost basis, which is around 92. And when we get to somewhere the base model, like one standard deviation below the cost basis of the short term, which is 70, or we get to, I don't know, around 78, the 200 day moving average, that's where we should sell the kidney. I call it the kidney price line. You sell the kidney and just buy the Bitcoin. But I'm not recommending sell your kidney, my friends and families. Just saying that is crazy. One standard deviation below the cost basis of the short-term investors, unless, like Sina said, some crazy change in the macro economy happens. That will be probably pushing the price even lower. So let's see what happens. Yeah.
Awesome. Yeah. So we'll keep tracking the market and we'll keep looking at the signs and trying to make sense of it all. And I think we had a really good discussion today.
Yep.
Thanks a lot.
Thanks for having.
Yeah, you brought us a couple of the hot, right out of the oven analytics that you had done for Gemini and other ones, and pretty good fresh look. All these chats are actually also keeping me up to date too, so that's fantastic.
A pleasure, always.
I appreciate it. All right, guys, we will see you next week then.
Yeah, see you everyone.